Hello, team. We are John and Tara Thorman, your money coaches, and welcome to this advanced training on compounding assets. It's the second video in our three-part series, The Keys to Financial Success.
The three keys are cash flow, compounding assets, and leverage. And today we're focused on compounding assets and the three elements inside of that, right? Now, you might think that you already know all there is to know about compound interest. Well, you don't.
I know I don't.
Right? You have been taught just enough to get you excited about investing your money in Wall Street, okay, and to try to grow your assets, but you've probably never received the training like what we've got for you today. Today literally could blow your mind and change your life. Why don't we call this exponential growth? We're going to get started right after you crush that like button and subscribe to the channel so you can become financially successful sooner so you can enjoy it longer, right? Okay, so let's get started. We're talking about compounding assets. So to achieve financial freedom, you must accumulate assets. This is not about eliminating debt, okay? That's focusing on the wrong side of the balance sheet, in my opinion. We've got to focus on the asset side of the balance sheet. Once your assets are paying you in cash flow every month more money than what you need or want to live your best life, you're financially free. Right now you got the option of whether you keep working your job or not.
Wow.
How awesome is that?
Awesome.
Okay, the thing with compounding that most people don't realize, the traditional concept, using a mutual fund or whatever, is that it takes a long time for it to work for you. Like we're talking 30, 40 years to get the kind of results you want. It's a long process, and you can get derailed early because the progress is really super slow. So you need to understand how this works, okay? But in addition to return on investment, which you're familiar with, ROI, return on investment, you're looking for what? 7, 8, 10, 12% a year return on your investment? That's the slow way to compound your money. There's a faster way, and it's called return of investment. How quickly can you get your money back so that you can reinvest it and make more money again really quickly and get your money back and reinvest it and make more money quickly? That is directly in alignment with this principle of the velocity of money. You always want to keep your money moving, right? Maybe the word itself has just lost its meaning. Like it's powerful, okay, but compound, what compounds, like a compound fracture? That sounds bad. Like I don't, maybe we've got just an association with the word compound or compounding that's not helpful. So why don't we call this exponential growth, right? We want exponential growth, and that growth curve starts out really slow and steady, and then it, takes off, right? That's what we're looking for to do with our assets. Now, you can control, and this is important, you have to control what you can control. You can control the money, you can control the rate of return somewhat, and you can control the time. And those are our three variables for the exponential formula. And we're going to look at all three of these: money, rate, and time. But we're spending most of our time on rate, the fun part, okay? We're talking about rate of return, and this is what's going to blow your mind. You're not going to believe this, trust me. So, but going back, the first variable is money. And it all starts with having some money to put to work. Okay? You do that in a bunch of ways, but one way is, and you know this one, spend less. Cut out the lattes, cut out all the fun stuff. Ugh, choke. That's not living a great life, okay? But you either make more money, increase your income, or spend less, or do both. And that'll free up cash that increases your savings rate, so now you have more money. But there's other ways to do it. Like, let's say you have a set of golf clubs, but you don't golf anymore. Sell them, okay? What we're doing is we're converting one underperforming asset and transferring it into another higher performing asset. We're focused on the balance sheet, right? List out, what do you own? What do you own, and is it producing? Is it really appreciating in value or bringing you income? If it's not, find ways to monetize it or sell it and put that money somewhere else, right? Another way is, as entrepreneurs, is thinking about how can you raise money, bring on investors to help you go and accomplish your next project and purchase your next asset, right? That's a great way to increase money and invest it. When it comes to spending less, that's something I want you to have fun with. It's like challenge yourself. So last year, Tara and I, we did this 90-day summer savings challenge, right? We were shocked at all the ways that we were able to plug, leaky holes in our bucket, right? And save money. Did you do a favorite one from last year?
I think what surprised me is that we had apps or things that we were subscribing to that we went back and we were reviewing and we forgot that we had them.
So that's one, money, right? Come up with money, find money so we can invest it. Now, number two, the second variable is your rate. And this is a function of good asset management, okay? And we're going to spend the majority of our time today talking about the rate of return. So it's important to choose your asset classes wisely, okay? Now, there's way more choices to invest your money than what Wall Street is continually telling you what to do, like 60% in equities, 40% in bonds, or 90% in equities if you're young, and 10% in bonds. Like, there's way more asset classes for you to invest in outside of the standard traditional asset allocation model of stocks, bonds, and cash. And we got to look at that, okay? So I'm going to give you a list here. We're going to run through them. I got 10 different asset classes for you to explore, just to stretch your mind a little bit, okay? Obviously, you can own a business. And if you have a job, awesome, but you could benefit by owning your own business and starting a side hustle, right? Or buying someone else's business that's cash flow positive already and operating that, or having someone else operate it for you and improving it and making more money. So business, big deal, number one. Number two, real estate. It's another asset class. Number three, gold and silver and commodities, okay? Especially in high inflation rate environments, that particular asset class right there, they will outperform, okay? Then you've got all the paper assets that you're familiar with. This is, Wall Street with the stocks, bonds, and cash, mutual funds and ETFs, okay? There's a place for them, but just don't put all your money there, right? Number five, we got options and futures. Don't listen to all the hype that it's super risky and it's crazy and insane and don't put your money there, because that couldn't be further from the truth. Next, annuity contracts. It's a whole nother asset class that Wall Street doesn't even recognize or at all. So we'll get into that later. I'll talk about it. Also, another great asset class is cash value life insurance. Mind you, it's not the traditional plan. They got to be designed intentional and specific to accumulate assets, but that is a phenomenal asset class for you to protect wealth, to accumulate money and earn great rates of return that's tax-free forever, okay? Next up, we got alternatives. Think about, there's art funds that you can put your money into, or wine funds that you can put your money into. There's crowdsourcing, there's peer-to-peer lending, there's just all kinds of options. Life settlements, there's a whole bunch more. But alternative investments outside of the traditional. We got currencies, right? You can make money trading currencies around the globe. And, of course, now we got cryptocurrency. That's the newest asset class, okay? So there's 10, and there's more probably. But I just want to expand your thinking outside of the traditional walls that are confining us, right? With stocks, bonds, and cash. Stocks, bonds, and cash. Now, maybe you're familiar with the legendary hedge fund investor, Ray Dalio. He spoke about the holy grail of investing. And for him, that was finding 10 to 15 uncorrelated asset classes. And by doing that, you could reduce your portfolio volatility or risk by about 80% without sacrificing returns. So I want to encourage you, again, look at these different asset classes. And if you like the wisdom of King Solomon, all right, in Ecclesiastes 11, verse 2, it says, invest in 7 ventures, yes, and 8. You do not know what disaster may come upon the land. So we want to diversify. I know an intentional mind shift is required here, because our thinking about asset classes and rates of return really is built upon a foundation of modern portfolio theory, which was designed way back in 1952. Doesn't make it too modern anymore, right? Like, a lot's changed since 1952, okay? Wow. So, Harry Markowitz designed modern portfolio theory, but here's the thing. Wall Street grabbed it and adopted it, And it was like, here, we can diversify your portfolio, stocks, bonds, cash, reduce your risk, and improve your return. But that was never intended for an individual investor. The modern portfolio theory is for institutional investors. It's not designed for you. And it leaves out way too many asset classes now that some weren't even available then when Markowitz did that thing, okay? But it leaves out too many asset classes that you can benefit from. We want to diversify between asset classes and reduce your systemic market risk. And if you're in all stocks and bonds, you're 100% susceptible to systemic risk. We got to fix it. Okay. Speaking about reducing risk, all the best asset managers and investors in the world are obsessed with never losing money. Yeah, exactly. Right? Remember Warren Buffett's 2 rules for investing? What's rule number 1?
Never lose money.
Yes. And rule number 2?
Don't forget 1.
Don't forget rule number 1. That's it. Right. So we got to be obsessed when it comes to improving your rate of return. We got to be obsessed with not losing money. Now, not only does it dig a hole and sink you to the bottom of it, but you lose time. Right. And time is your most valuable non-renewable resource. Okay. So you can't get the time back, so we don't want to lose money because it's inefficient. Right. Here's a question. Whose rate is it anyway? I am going to blow your brain right out right here, okay? Another important point when it comes to rate of return is knowing what rate you're actually talking about because they're not the same. Here's the example. Maybe you're familiar with Dave Ramsey, okay? Did you hear how I even said that? Dave Ramsey. Oh my gosh. I got an issue with Dave. I love him as a brother, but I just have issues with what he's teaching people. Okay. Dave Ramsey loves to tell people they can earn a 12% return on good mutual funds. He then uses the average annual return of the S&P 500 to support his claim.
He does.
Here's the problem, okay? Are you ready? What he's telling you is that the 12% number he's quoting is fake. It's the flaw of averages, okay? And he knows this, but he's telling you the fake number because it's bigger, and he's trying to sell you on buying mutual funds. He's trying to encourage you to save money because most people are not saving. They're not saving enough. But that's his objective, right, is to get you to save money. Oh, but it's not true. This is garbage. Let me show you. Average return, okay? I'm going to pull up the my little clipboard, handy dandy. Average return. So here's I'll ask this question. In year 1, you put $10,000 in an account and you earn a whopping 100% return. How much money do you have? 20 grand, right? In year 2, try to do this backwards. That's challenging. Year 2, okay, you start with 20,000, but now you lose 50%. The fund's down by 50%. So you are back to your original $10,000 balance, right? Well, here's what your average rate of return is. You take 100% minus the 50 you lost. You have a 50% return divided by the 2 years it took you to get there. You have a 25% average annual return. Now, which among you would think if your balance is exactly the same as it was 2 years ago, got a 25% return? Wow. None of you, right? You know it's zero. Your average return is zero. You didn't make any money. But, whoa, sorry, I'm getting excited. But the math is right if you are using the arithmetic average, the simple arithmetic average. 100 minus 50 is 50, divided by 2 years is 25%. That's 25% average annual return. No, okay, that's not how we do money. But this is how they do investments a lot of the time. When you have really volatile investments, using this simple average will make the number bigger and look better, so it's easier to sell. Right. Okay? Instead, what we want to use is not the arithmetic mean, okay? What we want to use is the geometric mean, okay? That will tell us what our actual compound annual growth rate is. And that's what we got to be focused on, CAGR, compound annual growth rate. That's real money in your pocket that you can spend, okay? Now, these are both math calculations, but Dave Ramsey's using the wrong math. Okay, we don't want the simple average. We want the compound annual growth rate, okay? It's always less when you have volatile investments. Always, okay? generally it's about 1.5% or so less if we just look at the S&P 500. So in addition to the wrong math, it gets even worse, okay? You're using the S&P 500 as the benchmark, but you can't invest in the S&P 500. It's an index, okay? So if you go and buy an S&P 500 index mutual fund, you're never going to get that rate of return because now you got fund expenses and hidden fees. And if you work with a financial advisor, they got to get paid. So there's fees for him or her, right? So your real rate of return on that index fund is never going to come anywhere close to what the S&P 500 is. But everybody's got you focused on the S&P 500. You're not getting that return. So if we look at a 30-year average, okay, from 1993 through the end of 2022, the S&P 500, the average rate of return is not 12%. But it's close, though. Okay, it's 11.29 or so, depending on who's rounding off the numbers. Okay. But the real compound annual growth rate, okay, is 9.66%. That's nowhere near 12. Right. Like not even in the same zip code, okay? 9.66. Now, that's not your real net rate of return either, okay? Dalbar does research. They've been doing it for like 30 years or more. And during that same 30-year period where the S&P 500 returned 9.66%, the average equity fund investor, any idea what their rate of return was?
No. No clue.
Brace yourself. 6.81%.
Wow.
So while they got us focused thinking we can earn 12% return, we're actually earning under 7. Wow. Now, even that might not compute for us all. So I want to take a look at this. If your financial plan is to retire with $3 million, okay? If you save $1,000 a month for 30 years at 12%, okay, you'll have just over $3 million. Okay? But remember, that's a fake number. That's not in your pocket. So if you invest $1,000 a month and you get the average equity fund return of 6.81%, in 30 years, you only have $1 million. Wow. You're short $2 million. Your plan, you're thinking, I'm going to be good. I'll have $3 million. You wind up with 1. You lost $2 million in the in-between because of the compounding effect of fees and bad math and expenses and hidden charges. Like, what? So this is why it's really important that you understand what you're paying for and what you're netting out, okay? Imagine getting to retirement and only having a third of what you thought you were going to have.
Wow.
I'd be some kind of unhappy, right? So we got to be aware of this, guys. So here's another factor that affects your real rate of return. You know what it is?
Taxes.
That's right.
And it is your biggest expense.
The biggest expense in your lifetime is going to be taxes, okay? And most of us never pay hardly any attention to it.
Oh, we just assume we have to pay them.
And we do.
We do, and they're huge.
The government provides incentives because they want you to do things to help them accomplish things that they're not going to do. Right. The incentives are tax breaks. So there's things you can do. If you follow the instructions, you can do things the government wants done and get tax breaks and not pay taxes. We just got to know what those are and how to do them, okay? But consider the type of investments you have and how you're going to have to pay taxes on them. Because you got ordinary income tax rates, you got qualified dividend tax rates that are lower, you got capital gains taxes that are lower. I mean, depending on your income, your capital gains tax could be 0%, 15%, or 20%. That's like, could be dramatically less. I mean, 0 compared to your tax rate could be dramatically less, right? So we got to be strategic about how we're moving our assets and how we're earning our money. Now, your real return after taxes and fees determines how fast your money can grow exponentially, right? So that brings us to our third variable, which is time. Right. Time is our most valuable non-renewable asset, right? Once it's spent, baby, it's gone, okay? You can't get it back. So the issue with time, like I said, when we're doing exponential growth, is it takes a long time, and you can get discouraged because you don't see much progress early. It takes 30 plus years to really see the benefit of compounding effect on your money. If I double $10,000, I have 20, right? I made 10 grand.
Mm-hmm.
But in the same time period, it took me to double 10,000. I could double $1 million.
Mm-hmm. Yeah.
Right? That's the exponential growth. Okay, but it takes time to build up that balance. So don't be discouraged, but don't let the time slip by. You got to put it to work for you as soon as possible. The sooner you start, the longer you have for exponential growth to work to your advantage. Now, I love this. Warren Buffett is probably the greatest investor in the world, right? He's 93 today and multi-billionaire. But you know what his key to success is? He earned great rates of return, right? I think he's over 20% a year compounded annual growth rate. But that's not really the issue. The issue is that he's 93. He started investing when he was
10 years old.
10 years old. He's been at it longer than anybody, okay? So if you've got $1 billion and you can double it, now you got $2 billion. It takes the same amount of time as it takes to double 10,000. The compounding effect of money, right? Those are the rules, okay? You just got to make them work for you. So, woo! That was a whole bunch, right? We got money, you got return or rate,
right.
and you got time. And, man, guys, you can work on those three elements for compounding assets, for exponential growth, and control what you can control. Like, do the best you can. Learn, right? Practice and train. We got to train so that we can go win our money game, okay? Next week, we're going to cover the third key of our 3 keys to financial success, and that is leverage. And it's not all debt. There's other options for leverage, and you don't want to miss that. So be sure to subscribe to the channel so you don't miss it. Crush that like button, okay? And be sure to leave us a comment or ask us a question. We'd love to interact and engage and provide some help and support for you. But that's it for today.
Very good, honey.
All right, baby. See you on the next video, everybody.